All right, so welcome to the recorded session on accounting for revaluation. I have two problems here that I would like to discuss. Okay, let's try the sample problem one here. So as you can read in the screen, okay, we have ABC Limited. So they acquired a fixed asset worth 10 million kina. Okay, and then there were dates. The appraisal was done, and it was sold. Okay, on a particular date. Okay. So our aim here is to journalize this transaction. Okay. So the first transaction that we will record is the acquisition. Okay. So if we record that, okay. So non-depreciable fixed asset and then cash. Okay. So because we acquired it. So the next transaction here is the appraisal done. Now the value is 10.5 million. So there was a revaluation increment. Okay. So we will record that. Okay, as you can see, it's only the difference between the acquisition cost and then the revaluation, as you can see in the formula bar here. Okay. Next, so if you have gain on revaluation here, you need to close this. Okay, our assumption here that the financial year ends at 31st December. So on 31st December, you need to close that. Okay. So gain on revaluation, which is under OCI, you close it to revaluation surplus. Okay, 500,000 kina. Right. So the next transaction, uh, so the value went down to 8 million. So from 10.5 million becomes 8 million. So the difference is basically 2.5 million. But as you can see here, you recognize a gain on revaluation and you close that gain on revaluation surplus because you had an increase in value from 10 million, it went up to 10.5 million. So, in recording this revaluation decrement, it is important for us to recognize that we had the previous gain or revaluation. Okay, so take note. So this 2.5 is the total revaluation decrement or the loss on revaluation. But because you previously recognized gain here, okay, which you already closed in revaluation surplus, you need to remove this because it's sort of like telling that it's not really or should not be recognized anyway because on the subsequent period you had incurred loss. So to offset that on revaluation surplus, you have OCI here, loss on revaluation OCI, and then loss on revaluation PL here. Okay, so you have to remove that first. Okay. Remember the total loss is 2.5 million. Okay. Which is the difference between, okay, so that is the difference between 10.5 million less 8 million, which is the, uh, new value, okay, as of this period. Okay. Then afterwards, you have to close this. Okay. You have to close the transaction. So here, so your loss on revaluation, basically, this 2 million will be close to retained earnings, but the loss on revaluation here will be close to revaluation surplus. Okay. Now on disposal, which also incurred gain. Okay, you dispose the property, which is now the value is 8 million here. Now you dispose it at 11 million. So the total gain that you're supposed to recognize is 3 million kina. Okay. So your non-depreciable asset here is 8 million because of the adjustments that you made on revaluation. The cash that you receive is 11 million. So basically your gain here is 3 million. Okay. And then that 3 million you need to close to retained earnings. All right. By the way, we are not reflecting, or we're just trying to show how the journal entries works, and I ignored income tax implication of this transaction. Okay. That income tax effect will be shown, or will be provided in uh, consolidation discussion. Okay. Now let's try almost the same problem, but here the difference will be uh, so still you purchase 10 million kina worth of property or fixed asset. Appraisal of this, it went down to 8 million, but on 30th September, the same asset went up to 11 million. Okay, and on 30th January, okay, of the next year, you sold it at 12 million kina. Same, our financial year ends will be 31st December, and we use revaluation model for fixed assets. All right. So the first thing, of course, you have to record it. So that's plain and simple, right? Now the first revaluation was done 31st December 20x2. Okay, and here, so from 10 million it becomes 8 million. So you have loss on revaluation. Okay. Now, if it is initial recognition of loss, you charge it to PL. Okay, so the loss on revaluation here will be charged to PL. So 2 million. So we got it from 10 million less 8 million. And this loss will be, or should be, close to retained earnings. Okay, of course, 31st December is the end of financial year end. So that is when you are closing the transaction. All right, the next, there was a revaluation made 30th September 20x4. So this 3 million, we got it from 11 million here, which is the new or revised valuation of the asset here, 11 million. Less 8 million, the previous one that you recognize. Okay, from 10 million, you deducted 2 million here. So 8 million. 11 million less 8 million kina, you have 3 million here. Then gain on revaluation. Now, this is important, and this particular area here is important. You previously recognized the loss uh, from PL, on PL, sorry, on PL. Okay, at 2 million. Okay, so what you will do is offset that loss to with the gain. But the gain here is not solely charged to OCI. The gain should be charged first to that PL, the 2 million. And then OCI, of course, the remaining. So 3 million less 2 million, you have 1 million here. Now, so these gains should be close to the respective accounts. Okay, so gain on revaluation under PL should be recognized in retained earnings, and then gain on revaluation, okay, which is 1 million here, okay, should be close to revaluation surplus. Okay. Now you sold this property. It says here you sold it at 12 million kina. Okay, so you sold it at 12 million kina. The adjusted amount of non-depreciable asset now is from 10 million, it becomes 8 million now, and then before this, it becomes 11 million. So the difference of 12 against 11 here, you have 1 million kina. And this, okay, this asset, okay, as you can notice here, still have a existing revaluation surplus here. Okay, so you need to remove that, this revaluation surplus that you have on this asset. Okay, so which means any revaluation surplus that you related to the asset that you're disposing, you remove that in your recording, and then you transfer that to retained earnings. And then, sorry, uh, all right. So you need to close this gain on revaluation to retained earnings. Okay, closing of gain on disposal to retained earnings. All right. So that's my presentation. You can always pause this video so that you will be able to get, okay, along the way, or you can always change the speed of this video in your uh, browser or in your player. Thank you very much for your time listening to my recorded lecture or recorded tutorial. I hope you learned something.